Adrian, good morning and thank you for joining us. Now, your CEO, Hugh Young, certainly set the cat amongst the pigeons when he said that Aberdeen Asset Management has reduced their India weightage. So, why have you reduced your exposure to India?
When you look at the valuations on the headline PE numbers, India does look on the high end of the range when you compare with other emerging markets and other Asia-Pacific markets. Of course, the hope is that the earnings growth will far outpace the other markets and justify those valuation levels. But on a valuation basis, India does look on the expensive side. When Hugh made that comment, it was quite soon during that time that we had the MAT uncertainty as well, the Indian tax uncertainty as well. So given these factors, it made some sense to take some money off the table. Rest assured, we still have a lot of exposure in the Indian equity markets, and the ones that we remain, we think will confidently outperform its peer group in the next 3 to 5 years.
We do have come off a good 10% from the peak for the markets. What would make you buy back that 2% that you cut off?
Well, you know, it's quite a fluid, dynamic situation. Like any other market, India is compared against its peer group. In its most obvious peer group is the emerging market space. Its most obvious peer group is its neighboring countries in the Asia-Pacific space. And so it's a fluid situation. I won't comment on whether we buy in or take profit from the market on a day-to-day basis. I think when Hugh made that comment, it was, yes, you're right, it was 10% more expensive then. There have been quite a few developments in the market as well. So I won't say any one thing would trigger a buyback of that magnitude. But we're always on the watch. And I think India is in a good position because it's got a strong selection of good quality companies. So when the price is right, we would definitely be looking to buy. But I can't give you 1 or 2 trigger points.
The point is, India, relative to the neighbors that you spoke about, has become a lot more valuable or less expensive than what it was. And some of the neighboring countries, South Korea, Taiwan, China, etc., have gone up as well. So is the relative picture looking a lot better than what it used to?
Yes, I think on a relative call, you can argue that. But we don't look at just China and Taiwan or Hong Kong alone. And within our regional portfolios, we don't have a lot in the Chinese market that have unfortunately done well. So on a relative performance, we have detracted. Our Chinese positions have detracted from relative performance as well. So you're right to say that on the average, India has done relatively well in terms of valuations. But on balance with the other things, once you go a little bit deeper than that, India does look a little bit more expensive. And I won't say we haven't taken profit from China and Hong Kong as well. So you can't quite compare it in those terms.
You reduced your India exposure across the board in some of your key holdings, or selling largely is concentrated around 2 or 3 large names?
It's very stock specific. We don't do a pro rata sell-off. You know, valuations in India, the range of valuations in India are very wide. And when you look at the state-owned enterprises, for example, you look at just one sector, just the banks, and they're trading at discount to book values. And you look at HDFC and ICICI, and they are trading at 2-3 times the price or the valuations of their counterparts that are state-owned. So valuations are very specific, and our trading calls or our short-term reductions are very stock-specific as well. It's not a pro-rata reduction.
Expensive stocks you own, they are Lupin, Asian Paints, Nestle. So can I safely assume that what you are selling and where you're taking off your chips off the table are largely pharma and consumer names?
You can't take that assumption as well. Because we have a little bit in Nestle and Asian Paints, but they're not large positions. So other than making a general statement on India, we've had these conversations with different people that are obviously stakeholders in the market. and they try and analyze what we would or would not be doing. I think Hugh's comment was basically a reflection on the relatively less attractive case for India. But on balance, that needs to be taken in context. We still have an overweight position in India, and we still have a lot of money invested in India. So I think a lot of market watchers, if they do follow this thread, are looking at relatively small movements and should have context in mind.
Adrian, I'm just looking at your top holdings as of March 31st this year. HDFC, of course, is at the top. You've also got a sizable Infosys, TCS, banks as well are in there, and then cement as well. Tell us a little bit more about whether or not you would be increasing exposure to these mentioned names.
So these are very large positions in our fund. At these prices, we wouldn't be increasing our positions aggressively. If we had money flow in from our investors into the Indian asset class, we would still be buying some of these names. So we need to, you need to take my comments in context of that. But I don't think we'll be aggressively buying stock in those names at these price levels.
Adrian, if the markets come off by 5-10%, and assuming that those are the levels at which you start finding India attractive, where would you look to add positions then? Assuming that all the stocks also come down in a similar fashion.
Will we be buying it relative? I mean, if the rest of the Asian market remains as is, and India pro rata falls 5 to 10%, and your definition is that we would find it attractively priced, yes, we would be putting incremental money into the Indian market.
Okay, but my question was also that what is it that you would find attractive in the Indian markets then? You already have large positions in a few key stocks or spaces that Ayesha mentioned. What is it that you find attractive or will find attractive? Let me put it that way.
Well, we have a 3 to 5 year time frame. It's pretty long term, and India's got a lot of promise. I like what India looks like now compared to what it looked like 18 months back. You have a situation when the inflation rates have moderated to a level that we think is sustainable, but more importantly, that the Reserve Bank thinks is sensible, and that indicates a softening of interest rate levels. We have a situation where the fiscal deficit in the government has also been reduced. We have a government that is pro-business, that is not afraid to take on changes. Some of these are difficult market reform changes, but it's not held back for a lack of ambition. I like what the budget indicated this year. Strong directional messages on further reduction of the deficit, strong message on simplifying the corporate tax code, letting the corporate tax levels fall, but then also reducing the level of subsidies and exceptionals that come with it. So I think from a macro perspective, India's a lot more attractive than it was for quite some time. And then when you look at the GDP growth rates, it's come off the bottom as well. So I think it's well positioned. Valuations are pricey, and that's the reason why we've taken a little bit off the top. But you've seen our numbers. We are still very heavily invested in the Indian market, and over the next 3 to 5 years, we're pretty confident it will outperform.
Adrian, let's do a complete, SWOT analysis. You've talked about the strengths and what's working for India. What about what's not working in favor of India? And is it only a valuation comparative basis with other emerging markets, or within the Indian boundaries as well, there are things that are making you a little uneasy besides valuations, which you've already talked about?
You do have to look at it across the emerging market space as well. And I would argue that India has quite a few, India's problems are not quite as painful as what you see, for example, in Brazil and Russia, for example. And part of India's problems are also internally generated. You have had a situation where growth rates were going at a pretty good clip for a long time. So when the Indian GDP goes south to 4% for a couple of years, I don't think it's a reason to be concerned. It's a reason to be concerned if you have a 3-month trading window or a 3-quarter trading window or a 3-week trading window. It's not an area of concern if you have a 3-year time frame or 5-year time frame. Yeah, there are certain things that India needs to do better, but all those things are known as well. Tax reform is important, and the MAT issue, which unsettled foreign investors, is important as well. Since the issue came to fore, we have had quite a few clarifications. The Parliament is sitting to deliberate on some of these issues, and we hope that we will get greater clarity quickly from both the tax authorities as well as the government, and that would be very helpful in putting the investment case forward. The underlying companies themselves we find very well run, very attractive on the whole, and but the tax environment does make it difficult for a foreign investor to get a certain level of predictability that it likes from the investment climate.
Adrian, what happens if this entire tax MAT issue continues to be a lingering one? Would that challenge then your current stance in terms of an investment into India? And do we see that 2% cut become a bigger one?
Yeah, I think that could happen. But there are lots of moving parts here as well. An investor doesn't look at just potential returns, and the tax drag on potential returns is something they have to factor in. But, if the markets were really soft, investors could be very forgiving for a difficult tax environment. Now, as administrators, you don't want those kind of circumstances to make your country attractive. But I think the message is clearly understood. The government's trying to do what it can, and we hope to get a quick resolution. But it will be an overhang the longer this drags out.
Spin the question completely. If there is enough and more clarity on the MAT issue, would you be looking at increasing your India exposure then?
We are flexible. I mean, you're trying to get a sense of what we would do. Effectively, we pick stock. And I think your viewers need to take that in context. We pick stock, but the stocks are also influenced by the investment climate they operate under, whether those are macroeconomic factors or tax or administrative factors as well. But we pick stock, we pick the relatively resilient businesses that are well run with strong cash flows, good balance sheets, and we hope to get a reasonable price for those stocks. And that's what we ultimately do. So ultimately, any buying or selling decision will not be dependent solely on macroeconomic developments or broad valuation. It would depend on stock-specific attractions. One stock, say for example, HDFC, would be compared against the likes of Stan Chart or OCBC or UOB, and that's how we make decisions.
Adrian, final question. I know we've extended our appointment with you. Aberdeen as a firm rarely changes their core portfolio, but in last 1 year, you've cut your exposure marginally to IT and you've increased your exposure to cement. What's the thinking behind this move?
Cement is relatively in a soft spot, and IT has made some good gains in short-term movements. But your viewers need to have context that those movements were less than 3% in the context of the portfolio. So I wouldn't say we've departed from changing our positions in our core stocks or core sector allocations.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.